Right. Welcome to this video session. So let's get right into it. Now, this is my 3D view chart. You can see it quite clean and clear. Now, this is where we analyze the market and be able to see what price has done and what price we do next. Now, the thing is, trading is not about being 100% accurate in predicting the market. No, most time is about likelihood playing out, trying to see what will likely play out next. That is what trading is all about. It's all about you seeing the story price is telling you, see what price is going to next, most likely going to next, and you joining price with your little funds to that destination. This market is being controlled by the smart money guys, that is the big guys, the central banks of nations. They control this market. Big funds, they have algorithm which they had programmed to control this market. So your goal as a trader is to see and know where they are taking price to next, and then you bet on that move. If you can't see clearly where they are taking price to, then don't trade the asset. Look for the next asset. It's as simple as that. Very simple. Just know where price is going to, and for you to know that price has to be one-sided. Okay, so let's talk about uh market trend, how the market move generally. So this is my pound dollar chart. Okay, uh you can see that from here, price made a low. This was last year, and then from here it kept going higher. From here it kept going higher to and then down to this place. When it reached this place, price then reversed. It began as a normal retracement, and then when it broke this low, the trend then changed to bearish. Now it then retraced back again to this place. So from here now, price is bearish. My expectation is that price will take out this low next. So as simple as that. So what happened from here down here to this top is what I call bullish move. Market is bullish. It is going higher. It's giving us new highs, new low. Why? What you see from here down, from here to here, from here to here, from here to here, they are called retracement. That is price pullback. It's more like as if you are climbing a staircase. There's an upward move, and then there's more like a steps for rest. Up, pause, up, pause, up, pause. That is how the markets move. If you see here to market from this top down here was bearish. It kept going lower, giving us lower highs, lower lows, lower high, lower low, lower high. What does that mean? It simply means that the latest high is quite lower in value, in price, compared to the previous high. Let me show you. You have this high, right? Here, if you link this eye with this previous eye, you can see that the previous one actually higher way above it. There's a gap in between them. This eye could not touch this eye, and it could not take it out as well. And then when you check again, this eye to this one quite lower than this one too as well. And then this one also lower than this previous one. So as price went lower, the latest high being produced by price is quite lower than the previous high. This is a classic bearish market. If it is a bullish market, like what happened here, you will begin to see higher high and higher lows. The latest high will be higher in price and value than the previous high. This is how the markets move. So when you open your chart, the first thing you have to know is what is the trend? What is the market trend? Is price bullish or bearish? Is price going higher or lower? That is the job. And if it is going higher, where is it going higher to? If it is going lower, where is price going lower to? And why is it going lower? And this will take us to the next topic, which is liquidity. But before we go to that level, I want us to get something right. I want to get something right clearly. Okay, how price move. Okay, um, let me show you something. Okay, if price is bullish, price will go high. Then we trace a little bit to make a lower low. The one is not making the low, it will continue to go higher again. The new high is higher in value than the previous high here. Then after a while, it also retreat as well. Then continue going higher, then retrace, then continue going higher, then retrace, then continue going higher, like that, like that. That is how price move. That is a bullish market. For a bearish market, you have something like this. It's go lower, retrace a little bit, then lower, retrace, then lower, then retrace, then low, then and then like that. It continue going lower. This is a bearish market. Now, this retracement you see, I will call pause or rest market. Price is resting, it's pause, it's to rest. You can see it right there. What we have here is a bullish move. Then what you have from here to here is a retracement. It continues higher again, and then it retraces again, and then went up again, and then retraced again, and then went up massively. So these are price move. It goes higher, retrace, they continue going higher, they retrace, they continue going higher, they retrace. Whereas if it is bearish, it will continue going lower, then retrace a little bit, then continue going lower. That is a bearish market. And this is what we call market trend or market structure. What does that mean? It simply means the structure that price is creating on your chart, that is market structure or market trend. So it is that bullish or bearish. It has to be that of the two. And in some cases, it can be a ranging market, that is not going higher or lower. Price is just uh it just consolidates within the same region. I'll show you an example of that anyway. Something like this can just happen like this. It's not going higher or lower, just like this. Now, when you see it like this, just steer your hand, don't do nothing. Don't trade the market. Why? It means that price actually accumulating liquidity from left and right, from sellers and buyers, before giving a massive move that will then move well. And that will take us to the next, which is actually liquidity. So, what is liquidity? Liquidity, in simplest terms, can be defined as the ease at which you can exchange an asset either for cash or cash for the asset. It's as simple as that. That is the ease at which you can buy or sell an asset, which simply means that for you to buy an asset, there have to be willing sellers, and for you to sell an asset, there has to be willing buyers from you at that current price you want to sell at. That is liquidity, and that is what power the financial market. Okay, so you can't buy something that there is no sellers for, and you can't sell something that has no buyers. So there has to be a demand, there have to be a level of volatility in the market for you to be able to buy and sell any asset. Okay, and that is where we make money from. So now, in the financial market, there's something called algorithm. Now, this algorithm, they're computers, AI, program to drive price higher and lower, to locate where liquidity is in the market. What does that mean? To locate where money is. Let me show you an example. On your chart, there's a way we identify liquidity. One of them is this high. Every high on your chart is a liquidity. Why? Because some people bought or sold in that place and they have their stop loss around that place. So it's a liquidity. That's it. There's money there. Also lows, every lows. You can see this one now. You see on your chart also liquidity. It's also liquidity as well, a low. And then this high too, liquidity, liquidity. And then low too, liquidity. And this two as well, liquidity as well. So every highs and every lows on your chart is a liquidity. And smart money algorithms look for those to take out. It they drive price towards liquidity at all times. That's why you see price making higher highs and higher lows. Why is price doing that? They are doing that to take out liquidities of old highs. If price is bullish, take out old highs. If price is bearish, you take out old lows. Like what happened here, it is bullish. This old highs was taken out here, right there. So that is a liquidity taken out here. And after doing that, it will trace a little bit right here. Then want higher again, we take out this old high as well here. So that is my money algorithm pushing price higher to take out liquidity. Apart from liquidity, another thing price also does is to fill an imbalance. What does that mean? An imbalance is the gap between three candles. Let me show you an example of that. Let's say this is a candle one, that is a candle, right? And this next candle is here, something like this. This is the next candle, right? And you have another candle lower or higher. Does not matter. The point is we have three candles, one, two, three, right? Now, here's what I'm going to. Each of these candles has its own wicks. The wick of this candle and the wick of the third candle, they do not touch each other. There is a break in between these wicks. This candle stop those two from touching each other. It serves as more like a middleman, right? Now, this candle right here is an imbalance. It means there is no 100% selling. So 100%, there is no 100% buying and selling in this move down. Hence, there are those that have their buy orders left unfilled. Hence, price will go back to refill that order. Hence, it's called an imbalance in market, imbalance in price, because there's an order that is yet to be filled. Now, let me show you an example of that on my chart. Now we have three candles, one, two, and three. Now, the low of the third candle and the low of the first, high of the first candle did not touch each other. There's a space in between them. You can see it. Let me show you very clearly. You can see it. Let me show the gap for you to see this gap, this space, so wide. You can see between them. That's an imbalance in price. What happens next? Price then will trace back now to fill that imbalance. That is an algorithm movement right there. That is how this market is supposed to work, to operate. If you look here, there's no imbalance here. There is no any space in candles here. The one we have here is between the one, two, three. These three candles, we have a space in between from the here to here. This small space, you can see it. That is an imbalance in price. Price will rebalance it, and the way it is going now, price is coming down to that place next. So these things are magnets that draw price to themselves. Let me show you another imbalance in the market. There's one here, right? From this high to this low, one, two, three candles. We have an imbalance here. You can see quite wide. Then price did what? Price to trace back into it to fill that imbalance right there, here, and then it went up. That's how this price moved. So price either moved to take out an old high or old low, or to rebalance an imbalance. That is how price move. Price will always seek to take out an old high or old low, or to rebalance an imbalance. That is how price move. Never forget this. It's quite important. So in the next video, I will advance more on this concept. So thank you. See you in the next video.